FOMC day. I hope you guys are excited for some interesting action over here. For those of you guys that have been around, I don't think anybody should really be surprised at this point. I don't know how you possibly could be. It's been a pretty wild day. Over here, we have Newsmax absolutely ripping for us again. Congratulations to everybody in LTMP. That is, again, nailing these names over here. If you guys are on options, I saw a lot of those being made free. The share trade's looking absolutely nuts. You got this one cooking over here. Fly, this is another interesting one. Shout out to Dave on this one. This one is moving around like crazy, but is looking very solid. You also have GSAT over here making that secondary move, looking very solid. You've got Weeble, after I've been screaming from the rooftops on this thing, just trying to help you guys make some money in the market. There you guys go. Another awesome one here. Still moving. I mean, this has got a lot of potential, guys, going into 2026. Fig is looking really good here. This is one that I outlined for you guys this morning. Again, I keep saying it. I've said it before. I'll say it again. The question is not if what we're doing over here is the best way to be operating in the market, because as you guys have seen time and time again, it obviously is. The question now at this point is how many more of these absolutely epic moves are you going to actively choose to miss? So, guys, we have a very interesting day ahead with this FOMC meeting. We are almost guaranteed to get a rate cut here. And then the market is really going to be bracing for what the tone of Powell is. As of right now, there are what the market is pricing in for the rest of Powell's term going into at the end of April. They're pricing in 0 rate cuts. After today, no more rate cuts is what the market is pricing in right now. So, again, we still have to see a lot of this economic data come out. We know the labor market is starting to weaken a little bit. Inflation, again, the PCE data was a little bit lower than expectations. We'll see if that starts to continuously come down. But if the data starts to suggest that the Fed could cut a little bit more here, those expectations could start to move back up for further cuts. And obviously, with what we've seen over the last month and a half here, with the market being incredibly worried, when these rate cut expectations go down, when the market starts to either de-price these cuts out there, the market will freak out about that. But what did we see? As soon as those rate cuts started to get priced back in, the market came right back up along with it. So there's a lot of interesting things that we could see over the next few months here. But team, it is that time of day again. Say good afternoon to somebody in the live chat. If you guys would like to say good afternoon to me, would love to receive some good afternoons over here. If you guys are new to the group, new to the stream, new to the channel, let me know. I'd love to welcome you guys in here. And as always, ladies and gentlemen, make sure you guys are hitting that like button on the way in. Costs you nothing to do it. But it helps me out a whole lot, spreading these streams out to as many people who actually want to learn. Again, if you guys hit, today it's going to be 200 likes on the stream. If you guys hit 200 likes on the stream, I will give you guys a couple of the absolutely epic setups that I have lined up for LTMP. If not, I'm just going to keep them for the group as always, but you guys all know the deal. If you guys use the link at the top of the live chat there, use code December, you get your first month for $1 a day, but we'll talk about that a little bit later. Why does this tone matter and not the actual cut? Because the actual cut is already priced in. The effect, the markets are forward looking. It's not going to be a situation where the rate cut happens and then everybody's like, oh my God, look, a rate cut. Everybody knows the market's expectation right now is very, very highly in favor of a rate cut at this meeting. And what Powell says at this meeting going forward is what the market's going to react to. Now, does it matter? No. It really doesn't matter. I've said this so many times that how many times have the Fed been right? Or I've sat here so many times over the last few months or the last few years here where some big narrative starts to happen, you guys start freaking out about it, or everybody starts freaking out. And I just sit here and I say the same thing I always do. I just don't care. Because when you look at the actual data and the board in total, nothing's actually changing. What Powell says today is not going to change much. What the rate cut is not going to change a whole lot. We still know where the economic data is, what this administration wants to do, and where everybody wants things to move moving forward here. So let's see who we have in here today. We've got Daily Taylor, Nate, Johnny, Rohan. We've got Rogue, Boomtown, Johnny, Arthur, Alpha. We've got Elegant, Todd, Romeo, Daily Taylor, John, another John, Matt. We've got Jerry. Good afternoon, ladies and gentlemen. So, yeah, if you guys hit 200 likes, I'll give you guys some more of these epic setups. I don't know how many more of these you guys are going to actively choose to miss. This is the simplest yet most effective way to be operating the market here. Newsmax, ripping. Thank you. Really, really awesome movement so far that we've seen this week, guys. I mean, I handed this one out for you guys on Twitter, too. I don't know how you guys are still missing these. But yeah, everybody, if you guys want to come in, join the group with us. Again, it's $1 a day for your guys' first month if you guys use code December, so don't miss out. That deal is not going to last for very long, and prices are going to continuously go up. So if you guys do want to hop in, lock in the lower rate, make sure you guys do that sooner than later. Well, let's see here. Yeah, Newsmax looking really good. GSAT still looking phenomenal here. If the market kind of holds up here after Powell, you could easily see some of these get some really solid continuation here. This one's already at break even for us, a risk-free. So this is going to be a fun one to see what happens with this. Bull is nasty. I mean, I don't know how I could have called this any more perfect for you guys. If you guys were paying attention on Twitter, again, as we were starting to move down, you saw a lot of people trying to get people to dip buy bull up at like 12, 13, 11, 10. What we wanted to see on bull was a base down below 10, and then ideally around 8 is where we wanted to see this, and that, again, is exactly what we ended up seeing. We saw a little bit of a trend shift there. You saw the big bottoming candle on their earnings after they released. Quite honestly, what were really, really solid earnings there. You got that nice period of consolidation, 2 breaks to the upside. The rest is history. You're now back above 10 with a nice little buffer. Newsmax contract just tapped 300%. Guys, I say this all the time. Imagine if you had the ability that every single trade that you take has the ability to run multi-hundreds, if not multi-thousands of percent. Welcome to LTMP. That's what we do around here. So, let's see. It's a little hot in here. So then we're also going to have, so we're going to get the interest rate decision and the prepared remarks at, at 2 p.m. And then at 2:30, we're going to get the Q&A. We also have an epic mastermind for you guys tonight, too. Newsmax is still going. Jeez, man. Look at this thing go. Here comes crypto. Ooh, is BM&R starting to go? That was another one I gave you guys. What's this looking like today? Yeah, BM&R, really, really nice start there. Again, this is another one I gave out at 36.60. The stock is now above 40. Those options must be cruising for everybody. There you go. There you go. Romeo. Yeah, I mean, I'll throw the link in the live chat here at some point for you guys, but again, I don't... If you guys haven't figured it out by now, I don't know what else to tell you. So, Newsmax looking good, Fly looking good, GSAT looking good. We're in position A, guys. I mean, as always. Let's see. Can I take a look at RGTI? What's it doing? Yeah, that one doesn't look like it wants to go for the secondary setup there. Doesn't look like it wants to go. Where's AMD? That's looking interesting. Yeah, BM&R is looking really good. Really good. Just cruising, man. I mean, these are the types of moves that you have to be in. If you want to learn to have long-term success in the market, guys, there are certain names, certain setups that you absolutely have to be in. And so one of the things that I've been talking about a lot with everybody, especially those of you guys that are still kind of starting to learn this stuff or getting into it, is that most of the time, a lot of people are just gonna they're gonna miss things that they need to not miss, if that makes sense, if they want to have a chance at succeeding. Remember, even when we were going through the choppy period in the market in like October and November, what was I saying? I was like, guys, this is now the perfect time after coming off a period where I handed out 35 10x trades. Just made Newsmax free at 240%. There you go. Dave gave out another great one, SHLS. Ooh, yeah, this one that we were talking about earlier. I like that one. Again, I wanted to see the base a little bit lower, but it still looks really good. AEO still sell. But here's what I've been saying. It's like, guys, after the 35 10x trades that I gave out to everyone, it was more than that, but that's the number that we were counting. It was a lot more than 35. What was I saying? I was like, there's going to be a little bit of a lull in the market. For those of you guys that missed all of those, that period of time, and it is still kind of right now, is the time that you really want to be learning how to take advantage of those moves. Because what's going to happen? Well, we're going to go into a period of time where I just come out on these streams here and go, oh, look, here's another 10x, here's another 5 10x trades. And then everybody goes, oh my God, I missed it. And it's like, well, I told you, all you had to do was learn this stuff right now. The Apex accounts are strictly for futures. Yeah, Apex is doing a 90% off sale right now, though. That's crazy. This is now the best time to be getting Apex accounts. If you guys want the discount, the 90% off, use code VIX, and you guys will get the discount, and I'll make like $2. What's he going to say, cut or no cut? They're going to cut. I would be very surprised if they did not cut. Very surprised. So we'll see. You guys actually might hit the like goal today. 200 likes, and I'll start going through some of the other epic setups that I have for you guys. I mean, LTMP already has all of them, so we'll go through and give you guys some more if you get up there. If not, I'm just going to save them for the group. I mean, how many epic ones did we see over the last couple of days here? BMNR, you had Newsmax. You had this right here. Fly is starting to look really good. GSAT is still looking phenomenal after that entry down at, what, 62.83? Am I really tensed all the time? I'm never tense. You guys see me freak out about anything ever in the market? No. Let's see. Bull looks really good. Bull looks phenomenal here still. But yeah, I mean, even just looking at some of the community gain section over here. Ooh, those figs look good. 138% on VOYG. Nice. 133% Visco. There you go. 102% Circle. 250% on Path. 250% on TE. 137% on MTW. 314% on Path. 416% on Serve. Oh, my Lord. Jeez, guys. What else we got here? 503% on City. Yeah, you guys, this is another one. I mean, the banks went absolutely nuts here. Look at this move on City. Picture perfect. I mean, if anybody's still holding the cities here, those are up even more. I keep trying to tell you guys, I don't know why everybody doesn't operate the way we do in the market. It's like this weird gap that people have between like, oh, look, you just should be doing this, and here is all of like the evidence as to why, and people still are just like, I don't know, maybe I should just go do something that is proven not to work instead. And it's like, what? Why would you do that? Is there a good boat behind you? Yes. Expecting a hawkish cut. Everybody's expecting a hawkish cut. Everybody is. It's all over the newsfeed. It's all over Twitter. It's what everybody's talking about. And it's not. So here's the thing. What people are saying is a hawkish cut isn't actually a hawkish cut. The Fed coming out and saying that they're going to cut rates and then wait to make their decision based on the incoming data is not hawkish. It's cautious. It's not and that's what people were missing after the last FOMC meeting. When Powell came out and said that a rate cut was not a foregone conclusion, the market lost its mind. Because they assumed that was hawkish. But what was the actual reasoning behind why Powell was saying that in the first place? Well, it was the only thing that it was that they were looking at is, oh, we're not receiving the data due to the government shutdown that they want to make a clear-cut decision, even though the data that they were receiving, especially on the labor market side, was suggesting the potential for a slowdown and weakening labor market. So the market, quite honestly, was just being stupid. It wasn't hawkish at all. It was just, we don't have the data. And I kept saying that over and over, which is why when we saw all that market volatility, I could just sit here all the time and be like, I just don't care. Because it's not reflecting any real concern in the market. If it was like, oh, inflation's spiking, it's like, all right, then we have to consider that possibility. Then inflation's going to move back to the upside. But even on the inflationary side, what have we talked about all year long with these tariffs? It's, well, the Fed is making a big mistake in treating this tariff situation and the potential increase in price levels as the base case and not just a possibility. And their comments were showcasing that. That spooked markets. Did it really do anything at the end of the day? No, it just introduced a little bit of added volatility to the market. That's it. Where can you text me? I mean, you can message me on Twitter if you want. I don't know why you guys want to text me, though. You guys all have access to me in the LTMP chat. Yeah, Dougie, if you have bull $10 calls that you were buying at the same time, those are probably up a lot right now. Good for you, man. Down here at this 920 area that we were looking at, good for you. But yeah, GSAT still looking good. Newsmax looking absolutely phenomenal here. I mean, again, that kind of first big kind of target area, 1030 would be really nice. I mean, what is that for risk to reward here? 1 to 7. That's pretty ridiculous. We had another one that the first target was like 1 to 18 risk to reward. Where is that one right now? SATL. Oh my God, look at this, guys. So this was, guys, I just please pay attention. It's not, like, I really try and help you guys. Like, I send these out on Twitter. If you guys like the stream, I'll give you some of these. Like, you guys have the ability to get into LTMP for $1 a day for your first month. Like, this setup right now is now sitting at a 1 to 8 risk to reward. And we were talking earlier today when this was trading at about a 1 to 5 risk to reward. That was a good spot to kind of move stops to break even and let it go to this next target, which is at about a 1 to 18 risk to reward. So, 12% on shares. Nice. So, this one trade, that guys, that even if you closed it right now, 1 to 8 risk to reward, you would then need to lose with the same risk 8 trades in a row in order to go back to break even. That is, again, I don't want to say it's impossible because nothing is impossible in the market, but it's so highly unlikely. SATL, yeah, about 13% right now. Nice. There you guys go. But the risk to reward on this thing is what's important because this is ridiculous. Banger trade. Epic. Then you've got Newsmax cranking. You've got Fly looking pretty good. You've got GSAT looking pretty good. BMNR is still looking really good. You've got, there's countless of them, guys. Countless. So, you have to realize that this way of operating in the market gives you such a wide margin for error. And like I say in the course videos, it's like you're going to have periods of time where you make more money than you ever thought was possible in a short period of time. But also, again, those big multi-100 and multi-1,000% trades that you guys see all the time, that's not the hard part of the market. Once you guys see what we're doing, it's really easy. The hard part is listening when I come out and I say, yeah, foot off the gas. This is not time to be going crazy. How high can Newsmax get? As high as it wants to go. It's still cranking right now. Look at this thing. It's just still cranking. Epic. Epic movement there, guys. Really great work. Congratulations to everybody that's been paying attention. For those of you guys that are late to the game, there's still time to hop in and learn. These setups are not going to stop. We'll see what happens during FOMC. We've got about, 13 minutes? We'll get the interest rate decision, and then we'll see what happens from there. But SATL, really, really good move there, guys. Really awesome work. So, I don't think I've sent you guys the link yet, but I'll throw it in the live chat for you guys. Again, if you use code December, you get your first month for $1 a day, so make sure you type in that code once you guys hop in. Again, if you don't see it now, you will event. I don't know how you guys don't see it after 35 10x trades and then all of the other epic ones that you've seen over the last few weeks. I have some more that I want to give you, but if you, again, you got to hit 200 likes on the stream, so we'll see. Oh, you guys are a quarter of the way there. You guys are a quarter of the way there. Ooh, I want to check one. There is one that I want to check here. Yeah, that one still looks really good. There's a few out there that I'm still kind of hunting that look nasty. And then after FOMC, we're going to see what the leaders and laggers are, and we're going to kind of go from there. But yeah, Apex has got a crazy sale. Crazy sale going on right now. 90% off. Those are whenever they do the 90%. Garlic cake, that's an LTMP joke. Took 3 different calls on Newsmax, one at 95%, one at 99%, and the last at 130%. Alex, congratulations, man. There you go. Welcome back to the game. Ram cook? No garlic cake, guys. Don't be doing any of that. I'll yell at you. You shouldn't be doing any of that. Why would we do anything other than the stuff that is proven to work in the market that you guys have seen can return multi-hundreds, if not multi-thousands of %? Why would we do anything else ever? Logically, it doesn't make sense. You guys actually might hit that like goal today. We'll see. We've got, 10 minutes-ish to go? Newsmax has been a ripper, though. Look at this thing. Look at this thing go. Congratulations, guys. I mean, again, we just keep proving it time and time again. Here we go. Here's another one. Hmm. 2026 is going to be very fun. McCake? No. Let's see. Is there anything coming through the feed right now? I don't think so. No. All right. PPTA. Fig is looking good. Where is it right now? Is it at the highs? Yeah, Fig is looking awesome off of that level here from this morning, 39.21. That looks really good still. First half of this year was weird. Well, there wasn't anything to do. That's the thing you guys got to realize too. Like, if there's nothing to do, there's nothing to do. And then you're going to also have the periods where it's just like, you think I'm just sort of some sort of market wizard where I give you 30-something thousand% plus trades in like 2 months. Like... But that's what the market is. People just have a fundamental misunderstanding of what operating the market actually means and what it is. What's PPTA? What's that look like? No, I don't like that. I don't like that. GSAT, still looking great here. Letting that thing ride. Oh, community gain. There we go. 13% on FIG. That's a good start. That's a good start. Yeah, I mean, this thing could really go. Like, if you even get back into this range, like 12 to 13, like, even think if this thing just goes to 12, what the risk to reward on that is. 1 to 14? Oh, my Lord. Oh, my God. Newsmax free runners. What is that? 1200. Oh, there you go. There you go. Nice little base hit there. Hymns. Let me take a look at the chart on it right now. Nah, I don't like that right here. It's not too great there. All right, 8 minutes here. Yeah, the Newsmaxes get snappy. I mean, this is, again, a lot of these make more sense for share trades. And, again, all of you can do this. It's not hard. Do you guys know how much effort it takes me during the day when I'm in the share trades? 0. None. You have the alert set on your phone. The alert goes off. NVT and SATL cruising. Yeah, SATL is looking great. I mean, that's at a, right now it's at a what in terms of risk to reward? 1 to 7? Almost 1 to 8? Stops are at break even, let it rip. There you go. Like, think about it, guys. There's a reason why everybody loves LTMP. It's like, it's because every trade that I outline has the potential to run multi-hundreds, if not multi-thousands of %. That's why it works so well. We're finding stocks that are about to explode before they do. It's not hard. When you guys see how simple it is, you'll have the same feedback that everybody has once they hop in and go through the videos and they have that light bulb go off. They're like, oh my God, I wish I was doing this the entire time. And I'm like, I know. I tried to tell you all this time. Do you actually enter positions in every play? That's literally impossible to do. Of course not. I'm not in all of them. Are these 3 too late to buy shares? Yep. You never want to chase. That's why they're outlined for you beforehand, and you have, like, the whole point of the group, guys, is to make you guys self-sufficient. That's what it is. Like, there's a reason why you're able to see me showcase, like, results from the students in the group that are so much better than, like, any other group out there. It's because it's not about, like, anybody that's telling you, like, oh, alerts, follow my trades, never listen to them. One, it's illegal. Two, they are actively hurting your chances at having long-term success in the market. The only way that, if you guys want to have long-term success in the market, I know exactly what you need to do. All you have to do is listen. It's not that hard. You have to understand the exact reasoning behind when and why you're entering the trade, how you're going to manage the trade when you're in it, and exactly when and why you're going to exit. 2 weeks just coming in again. Yeah. I mean, all of you can do it. Like, I could teach a 4-year-old this stuff. It's not hard. It's actually really simple. Like, when people see this and I explain it to people, they're like, what? That's as simple as it. I'm like, yeah. It's like, why does everybody fail? I'm like, I don't know why everybody struggles in the market. They try to overcomplicate it, do all sorts of nonsense when they could just be doing this. You know? There's always another one. Yeah, I mean, there's always great setups coming. GSAT still looks good. Newsmax looks good. All right, we got 4 minutes to go until Powell. We're going to get a lot of headlines coming in here in a minute. Let's see what we got. What's the market doing? Just grinding down a little. JP Morgan gives $1,000 to staff who earn under $80,000. Okay. Do you also enter? You just asked the same question. No. Imagine there are a bunch of needles in a haystack around the market. I'm just saying, and your job is to find them and then execute on them. I just show you where all the needles are. You're like, here are the best setups in the market. Okay. EU, you are now getting put on timeout for questions. All the questions, stop. Listen, watch the videos, ask me questions after you do that, but you probably won't have to because it's so simple. Shares only. Yeah. Yeah, shares is great. I love shares. All right. Yeah, I'll throw the link in here. Everybody, you guys can all get your first month for $1 a day. Use code December. And you too can learn how every single trade that you take can return multi-hundreds, if not multi-1,000%, if you just follow a very, very simple strategy that we call the LTMP method. Do I like BBAI? I don't know. Let's see. Yep. I like that a lot. That looks really good. That looks really good. Best group around, 8 straight months of gains only because I followed SCV's rules of the group to a T. Very helpful members in here also. Thank you, buddy. I appreciate that. Yeah, I mean, you guys listen. You're going to put yourself in the position to have some really, really insane results. All you got to do is listen. It's not that hard. This is looking really good, though. If you get this move up to the 200 EMA on this thing, on SATL, you have a 1 to 30-something risk reward trade. You risk 1% of your account, you return 30. Okay, I'll take those trades all day long. All day long. Look at this thing go. So, all right, less than a minute to go here. We got 40 seconds. Let's see. I'll be on it on the news feed. So we're going to get the interest rate decision, and then at 2:30, in about 30 minutes here, we're going to get the Q&A with Powell. 12% on your SATL already. Great work. Great work. Yeah, GSAT's looking great today. All right, here we go. What do we got, ladies and gentlemen? Nothing out of the market yet, really. Let's see. Come on. Ooh, little rip. Fed cuts key interest rate by 25 basis points. Oh my God, I'm so surprised. All right, we got to wait for the Nikki Leaks comment too, because that will be important for us. But here we go with the market moving up. It's got to see something that it likes right here, because here we go. Here's the Nikki Leaks comment. FOMC cuts by 25 basis points as expected. We have 3 dissents. Goolsby and Schmid opposed the cut. Mirren wanted a 50 basis point cut. Oh, wow. The SCP, the Summary of Economic Projections, shows 6 officials of 19 didn't favor a cut. The median dot is unchanged for 2026. The Fed will start reserve management purchases this week. Is that freaking QE? Beginning at $40 billion per month in T-bills. They just basically announced QE, I think. Oh my God, everybody gets so worried about the market all the time. We know what they're gonna do. All right, let's see what Walter is saying. Fed says we'll buy $40 billion of Treasury bills in the next 30 days. Yeah, that's starting QE. It's like QE, not QE. Median projection maintains 25 basis points of rate cuts in 2026. That is definitely subject to change. Fed will consider extent and timing of additional adjustments, obviously. Yeah, it's interesting. Okay, hold on. I'm going back to the feed. Yeah. All right, guys. So, again, make sure you guys are hitting that like button on the way in. If this is going to be the case, there's no matter what happens today, and depending on, well, it kind of depends on what Powell says for the next couple days here, but we are setting ourselves up for some absolutely ridiculous setups. If you guys thought 35 10x trades in like 3 months was ridiculous, get ready for what I'm about to show you. It's going to be insane. So, hopefully you guys have paid attention. If not, like my favorite phrase, pay attention or pay a premium. You know, this is going to be really fun. So GSAT looking good there. Fly looking good. Newsmat, everything's looking good here so far. So you got that initial move. Okay. Let's see what else we're getting on the feed. Yeah, so they're signaling modest cuts in 26. Right now, this is a dud. Let's see what they do with this. What are bonds doing? Yeah, down now. They're bidding up bond. How did bonds just nuke down on this? Yep. Yep, that makes sense. Pretty interesting. Pretty interesting. The feed's a little slow here. I can probably look at it here. Signals it may be done for now. Okay, I mean, they do this every single time. The Fed always cuts and then signals that they're going to be continuing to be more data dependent. They do it every single time. It's not, this is the December FOMC meeting, not the next FOMC meeting. That's what people fail to understand most of the time. Yeah, CRM does look really good. But that is one thing that people just fail to realize. They're like, oh, the Fed is saying that they're going to be, they may not do any more rate cuts. It's like, well, yeah, that's because it's this meeting and not the next meeting. Like, why? What do we have the data that's going to come out from between now and the next meeting? No. Okay. Relax. Wait for the data to come out, and we'll get a better understanding, even though we kind of know where the data is already trending. Okay? So, market's looking good right now off of FOMC. We'll see what Powell's comments are. He can obviously shake things up, especially after getting what he would most likely is going to get a comment about the shadow Fed chair. Let's see. U.S. interest rate futures price in 78 chance of a pause in January meeting versus 70% before the rate cut. Futures imply traders see Fed policy rate at 3.1% at the end of 2026 after the Fed cut. Little change from levels just before. So basically a dud. So, yeah, we have about 25 minutes now until the, what do you call it? The press conference pulls up. So let me actually get this ready to go for everybody. Okay, let's see. You shouldn't be able to hear this. Yeah, okay. Yeah, moving. What are my babies doing? Where's AMD? Is AMD moving? Yeah, bonds down, that's good. AMD. Nothing, that's pretty interesting. Facebook, what's that doing? Facebook down, that's kind of weird. Oh, GSAT moving, there we go. Nice. There we go, guys. Look at that. Oh my God, another one for us. Who's surprised? Is anybody surprised at this point? I don't know. Those shares are up 14%. Thanks. I'm just going to keep doing this for everybody. It is not that hard. Once you see it, you can't unsee it. So, yeah, the press conference will get interesting. The press conference will get very interesting. Well, we'll see. Yeah, if you guys, in the meantime, you guys have any questions about any tickers, our process of operating in the market, anything macro related, just ask. IO and Q moving? Not really. I mean, that's just still kind of setting up, holding the 10-year. SoFi getting a little pop. Ooh, yeah, where's Bull? Hold on, where's Bull? It's not really moving. NTAP moving? I don't really remember looking at this one. I don't really like that one. That's not really what we're looking for. Yeah, really good day today, though, guys. Congratulations. Again, Powell could still shake. Yeah, really good day today. Oh, it's moving now. It's moving now. What else are we getting on the feed? Okay, now we're seeing Fed swaps still expect about 50 basis points of easing in 2026 versus another report that said 25. That's interesting. GSAT, hello. Newsmax. Where's Bull? Is Bull still at 10.15? Oh, Bull's starting to move a little. Why do we shrink the balance sheet, sir, so we can expand it again? That's so funny. RKT's moving. Oh, yeah, the real estate names are probably doing well. Where's Real? Not really moving there. That's interesting. Actually, that's not real estate. That's the real. Whoops. Sorry. Yeah, RKT's moving. What was the other one? No. Oh, Remax was the other one. Yeah, there goes Remax again. That was the one I was thinking of, not Real. Real was another one that we were looking at. Novo's moving? Which way? Which? Oh, hello. Hi, Novo, up 5%. I like that. Oh, gold is moving? A little bit, but again, with what we're seeing here, with basically QE coming back, what have I, again, guys, what have I told you? The Fed is okay with letting inflation run a little bit above target as long as growth is not sacrificed. What does that mean? If the labor market starts to weaken, they're gonna cut. Yeah, Remax was the other one. So what is this? It just in terms of like a risk to reward on the gold position that I have, if it was a trade, which I know a lot of you guys took, that's still sitting at a 1 to 24 risk to reward trade. Newsmax still ripping here. There we go. So is GSAT. That's looking good. Wow. Look at this, guys. SATL new highs. Yup. There we go on that one. Oh my Lord. We did it again, ladies and gentlemen. So, does Circle have another breakout? Oh, yeah, it looks good. Circle looks good here. What was the other one? Oh, Fig. Where's Fig? Yeah, Fig is looking great too. Open has actually a really interesting weekly chart. Really interesting weekly chart there on Open. This is the daily, but I'll show you the weekly. It's not great, but this is really pinching here on top of the 200. I like this. So, if this is going to be the case, guys, I don't think you are ready for what's about to happen. I've tried to warn you so many times. I keep telling you, this is the way you need to be operating in the market. I just hope you guys are listening. Edge, welcome to LTMP. So again, for all of you guys that are hopping in, again, make sure that your Discord account is connected to your WAP account, and then once it is, you guys will get automatically let into the group. Once I see you, I'll direct you to the start here area, and then you will be able to start on the curriculum videos. That'll get you going in the right direction. If you have any questions on that, that's your first step. Just ask. I'm always around to answer. Let's see. GSAT back down. This still looks ridiculous. So we'll see if GSAT can continue. Fly, that looks interesting. What's the market doing? It's moving. It likes what it's seeing right now. Gold turns positive. I bet silver's really going on this. I might be wrong, but... yeah, it's silver up again. What was the... oh, PAAS. That was one that I called out for you guys yesterday. How's that doing? Or that's the weekly, sorry. Yeah, that's this was a really good one off of this break here too. Like guys, I keep telling you, there's like too many of these for me to even like mentally keep track of right now that are just ripping. This is another great one. I mean, what is this trading at in terms of risk to reward right now? Probably like, I don't know, 1 to 1.5, 1 to 2, something like that. Yeah, that's not bad. It looks good though. That could easily get going. Fly looks good. Newsmax looks good. GSAT looks good. Fig looks good. 93% on BMNR. Oh, I didn't even look at that. Yeah, there it goes. Yeah, so for those of you guys that were paying attention yesterday, hopefully you were, but a lot of you probably weren't. Here's another one, 3658, 3660 was the level that we were outlining on BMNR. That's another really good one. Like I said, if you get a positive reaction off of FOMC, in crypto, we see like more risk on. You could easily see this thing come back right into the mid 40s, like in an instant. Yeah, PAAS looks really good off of that. Guys, give me 1 second. I'm gonna grab my water, but I'll be right back. Again, make sure you guys are hitting that like button on the way in. If you guys do it, 200 likes on the stream today, I will start handing out some more of my favorite setups to you guys. If not, I'm just gonna keep them for the group. But yeah, there you guys go. Use code December. Get your first month for $1 a day. Hit that like button. Give me 2 seconds. I'll be right back. Yes, City's all. We're going to look at City when we get back. All right, I'm back. Hello. Yeah, let's look at City, because City's been ripping off of that setup there. Yeah, is anybody still in this one? Because this is ridiculous. It's a major bank just ripping. Weibo looks good. Yeah, I'd love for GSAT to move back up there. I mean, it's been a little funky, but it still looks good. This has some serious potential. Fly. So does I mean, we already saw Newsmax. Do I like IRBT? Let's take a look. Isn't that iRobot? No, I don't like that. You have leaves for July 17th. City? That's not... okay, I could see that. You have January for City? Yeah, those are all probably looking really good. Yeah, GSAT moving very strangely. That's okay. I still love it. 140% on... nice. Yeah, I mean, the shorter expirations on City, I saw earlier this week 500% for some of you guys on them. That was really good. Yeah, GSAT's being a little annoying. Fly looks good. Newsmax looks great. Bull looks really good. I bet what's the other one's Fig. Figma. These are some of my favorite charts. There's two types of charts that are my favorite. These shifts off of bases, like you're seeing out of Newsmax right now, This is one of my favorite looks on a chart. And the second is, I'll show you. This, ready? Right here, that. Where I bought gold on that break, the weekly breakout at 317. You see what I'm looking for? Arthur, the problem is that even if you see what I'm looking for, until you actually go through the process of learning how to execute the setups within how I teach them, you're going to completely screw it up. Like, it's so easy, but it also means it's easy for you to mess it up if you don't know what you're doing, you know? So don't try and take any shortcuts. It is not that difficult. You just have to take the very short period of time that it takes to learn, and you're going to be good to go like the rest of everybody else, you know? We got about 15 minutes until Powell comes on here, but Fly looks good. Like, those are my two favorites. Like, that's why I say, too, a lot, where it's like, even when I'm showing you guys this stuff, like, on the stream, it's not meant for the people that are out there to take it. It's meant for you guys to see what's possible if you listen. I'll probably do a Newsmax tweet here. Oops, I didn't mean to do that. I had to do something else first. Darn it! Pay attention or pay a premium, ladies and gentlemen. Up 8% on Newsmax just today. Bang, 97X. Oh, Fly is moving there too. That's good. How long do I take? As long as I need to. Is LTMP a Discord server? Yeah. Well, yeah, you sign up through WAP, but then yeah, it's all on Discord. Yeah, really good day today, guys. Really good day. Congratulations to everybody. I mean, it's been a really fun week. Ooh, Fig cracked 40. That's really good. Well, I think that's new highs on Fly, isn't it? Oh, no, it's close. Here comes the market again. But yeah, I'll throw the link again for you guys in the live chat. Again, the code is December to get your first month for $1 a day. There you guys go. Fly could be a really big one. NEM pushing higher. That's a gold one, isn't it? Newmont? Yeah, that's another good one. Newsmax over 10 would start to get very interesting, because then you're within striking distance of that 1030 target. I don't know if I'll trim any there. We'll see. With these shares trades, guys, I like to just let them go. You know? I like to just let them rip and let them do their thing. Like, I've been sitting in GSAT since this day. It's just rip, chop, rip, chop. This thing could just stair step all the way up to 90 something. Why would I sell it if it doesn't show any signs of me needing to, you know? I didn't like this candle, Friday's candle on it. Not a fan. Did I get the break on Fly? Yeah. Oh, you're way above that. Like, even if you were looking at this level right here. Like, you kind of wanted this right around 2032. You really could have gotten this thing at, like, right around 1996. Yeah, I know a lot of you guys grabbed this one. So, I think this is the one that Dave sent. So, remember, we had SATL, which is another one of these smaller aerospace companies. But then Dave also threw in Fly. This also looks nasty. Can you try for 1 month and then see how it is? Yeah, just join. Use code December. You get your first month for $1 a day. Listen, guys. Again, like I always say, pay attention or pay a premium. That's what those deals are for. Lift. Garbage. Garbage! But again, I'm going to force you to put the effort in. This is not a following around type of thing. And it's, again, people are going to be like, oh, I want that. It's like, okay, so then you're just admitting that you don't actually want to have success. That's fine. That's okay. Most people won't. If you listen, you have a really good shot at it. SATL looking really good there, though. See, what's the other one? Fly. This could, I mean, guys, imagine if this goes to 33. D-Nut? There's, all right, are we really looking at D-Nut right now? Oh, God. This is the, all right, once I give something that's like one of the craziest things ever, like the 3,000% D-Nut, I feel like people want to just hit it again. But, like, guys, you saw it all. Like, I'm not going to... Once we do our dirty work on something, I usually just leave it alone. I'm like, why try and force it on it again? Like, there are certain instances where it does make sense. Like Open. Open's a really good example of something where, like, if you didn't hit it the first time and chased it a lot higher, there was another opportunity on this thing on the continued move, which I gave out to you guys at 265. Which was really good. The stock almost quadrupled in, like, I don't know. D-Nut? No, I know. It doesn't mean that it's going to do it again, you know? Newsmax, new highs. Thank you, ladies and gentlemen. We're cruising today, folks. My Newsmax shares are up 14% in 2 days. Guys. What are we doing? What are we at in terms of risk to reward on this thing right now? 1 to 5. Thank you. Stops are at break even. Let it rip. Let it rip. All right, we got 8 minutes to go until Powell. We'll see what Powell wants to do here. Maybe he just says screw it and just starts pumping. Who knows? I doubt it, though. I doubt it. He probably tries to reel this thing back in a little. Powell's going to be like, is Ford too wicky? If you have to ask, probably, but I can take a look. I bet the weekly looks really good. No, Ford looks awesome. This weekly chart on Ford looks dirty. I love that. Setting a contract sell on Newsmax at 400%. What are you at now? Matt, what are you at now on Newsmax? It's got to be a lot. But think about it. So I want you guys to think about it like this too. Especially on something like Newsmax. This is why I've been talking a lot about shares with you guys over the last few weeks here. This is at about a 1 to 5 risk to reward. So if you're sizing your options appropriately, that would mean that the options would have to go up over 500% in order for you to just equate it to the actual, like, R multiple that you would get on shares. Because with options, your position size should be your risk. 362%. Damn! Oh, look, another multi-100%er. But think about it like this, too. The risk to reward profile, like I say all the time, is better on the shares. How's D-Nut on a weekly base? It probably is, honestly. It is and it isn't. This is just kind of a wiki grind. It's not a great base. You know? It's like okay, I guess, you know? It's not really what we want, you know? For a base. Where's Bull? How's Bull looking? 1020? Pretty good, honestly. Again, like I told you guys too, like the next step of me looking into the magic crystal ball on Bull that I've already outlined for you guys, it is going to be difficult on Bull or in this range. because like if you look back here, it's just looking at what buyers and sellers are doing. What a lot of people do is they'll try and wildly overcomplicate things, use all sorts of indicators that don't matter, think that there's some magic algorithm out there that's going to be some sort of cheat code to the market. It doesn't exist. Stop doing that. You're wasting your time. All you got to look at and how you have to view the market is a reflection of buyers and sellers' emotions. Now, it's very obvious. This is one of the ways that I get a good gauge of this. It's very obvious when people start to get very worried about the market. Why? I can see it in all of you guys. Even though I know all of you, a lot of you guys are pretty solid in terms of like the way that you view the market from an emotional perspective. In total, even you guys on this live stream here are not very good at it. So I can sometimes use you guys to say, all right, how are people actually feeling about the market? You can see it in their tone. Now, the other thing is you can also overlay that on a chart. So, like, what were the buyers actually saying down here? Well, they didn't really want to let this thing continue lower. This is a pretty interesting area of demand. They pushed it out. Now you started to see the same thing back down in here. The buyers tried. The sellers took over and sold it through. Okay. Now we came down, we formed the base that we wanted to, and now we're back at the area that previously the buyers have said, we're willing to buy it at these areas here back in June to send it a lot higher, but also the sellers were pretty aggressive down in here pushing this thing lower. So odds are you're going to see a decent amount of chop in this area here unless something else happens and you see a big push out of here as a result of news or something else. Sold half your Newsmax contracts at 246%, keeping the runners. Alex, congratulations. Arthur just joined LTMP. Welcome, welcome, welcome. Again, welcome all of you guys. We're going to get all of you guys up to speed. Remember, when you guys do hop in, make sure you guys have your Discord account connected to your WAP account, and then you'll automatically get let into the group. Once that happens, I'll direct you to the Start Here area. You'll be able to go through all the learning curriculum videos. You start with the Swing Kings course. That'll get you up to speed. And you guys will be all able to start doing this for yourselves in no time. And with what we just saw at the FOMC meeting, it's going to get interesting. The ticker is literally bull. How could you not be bullish? It does have that kind of meme factor to it where it could get buoyed up by Wall Street bets. But, like, at the same time, like, the growth in that name is pretty significant. And it's got a ridiculous chart. Like, also, if you think about it, we've nailed fintech really over the last, like, few years. And also, like, all the people that are going to be looking at stocks anyway, a lot of the time they're looking at it on Webull. So I like it. We have a really good entry so far. I'll still look to add more. I probably at some point want to double the size I have it on it right now. But I'll probably wait a little bit to do that. What color is the tie going to be? I don't know, but we have 2 minutes, guys. 2 minutes until Powell. Remember, everybody, make sure you guys hit that like button on the way in. Cost you nothing to do it. Helps me out a whole lot spreading these streams out. Again, I stream every single day for you guys on here at 10:30 a.m. Eastern. Fridays is public live day. I come on about 15 minutes before market open for you. So again, if you guys don't have notifications turned on for the channel yet, make sure you guys do. Pay attention or pay a premium. And if more of you guys come on the stream, we'll probably hit the like button, the like threshold sooner, so then I can give you guys some more setups. The last time you guys hit the like goal, it was PDD, and I gave you a 300-something% trade. The second time, I tried to give you FedEx. You guys didn't hit the like goal, and it ran 3,000%. So, you're seeing a lot of red? I don't see that. A lot of things are looking great. The Colt is here. What's up, H2? How you doing, buddy? Yeah, I love Newsmax. Great move so far. So, all right, let me, where's Powell? All right, so we got less than a minute to go here. It's going to be fun. It's going to be very fun, guys. I hope you guys are ready. Yeah, so tomorrow the YouTube videos should be back too. I just haven't had a chance to do any of that over the last 2 days here. So, Oh, here he is. Hey. It's fine. I'm already demonetized on YouTube because apparently you're not allowed to showcase the best results that anybody has ever seen in the market before. Oh, here's 1,000% gain. Yo, here's another one. Oh, here's a stock that's about to explode. Oh, that one ends up being 1,000% gain. I guess you're not allowed to do that on YouTube or Instagram. Instagram banned me too. That was rude of them. Just trying to help. Just trying to help you guys. Oh, but they let the lifestyle marketers scam everybody. Oh, got it. Okay, I'll go buy a car right now, and then I get a free pass, I guess. Oh, I'll go get a stupid $15,000 Rolex for no reason. And then, oh, okay, Powell's on. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well-positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive, and as I mentioned, AI spending will continue. The consumer continues to spend, so it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time, so it's basically a good thing, but that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is?
Remember, the Fed is fine with letting inflation run above target as long as growth is not sacrificed. So the unemployment numbers are more important right now to the Fed than the inflation numbers. This is something that I've said so many times over the last few months. All right, let's keep it going.
Thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we don't think that we help matters by trying to engage as a public discussant of that. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to to the two things, and we look at how far they are and how long it would take to get them back to, each of them back to the goal. And that's a very subjective analysis, really. But it just tells you you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say, and that's what we're doing now. It so happened that we've cut 3 times. That, you know, we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, you know, it takes, there's the announcement of a tariff, and then there's, you know, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, you know, it may take, you know, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, you know, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. You know, we haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
Mike.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, you know, that's one part of it is inflation compensation break-evens. And, you know, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, you know, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, you know, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2%, because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember, when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
When we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low. If there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Enda.
Thank you, Chair. Enda Curran, Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
on the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine. Thank you.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a price stability and a strong labor market. And what we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record. Yeah,
so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's made it expensive for them to move. And we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time, and so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to make an assessment, and this is the assessment we made.
Hi, Chair Powell. Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about the bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman, Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
All right, ladies and gentlemen, that was a very interesting FOMC meeting. I hope you guys understand the reasoning behind, at this point now, after this FOMC meeting, why over the last month and a half, I was just so unbothered by a lot of the market volatility. Like I say all the time, if you can understand the big picture of what's going on, and even that one statement that we've been talking about where it's the Fed is fine with letting inflation run a little bit above target as long as growth is not sacrificed. And along with growth, you're really going to be looking at the labor market. So the labor market has been key. Every single time we've been seeing these layoff numbers or ADP private payrolls, all of that has been in support of cuts. Now, we'll see what happens with the inflation data over the next few months. I think at this point, the market might start looking more towards a lot of that inflation data, saying, all right, now that we've gotten our cut here, we need to see what's going to happen with inflation and how long we are actually going to see inflation run above target. But if the labor market keeps deteriorating, it's not going to matter. They're going to continue moving rates down and continuing to loosen economic conditions. So, folks, Newsmax ripping all the way up to 10 there. You've got Fly looking good. You have Fig looking great. You had a couple of other movers that were breaking here. Guys, what an absolutely epic day for those of you guys that have decided to take that right step forward. and join us in LTMP. I mean, like I always say, the only question you need to ask yourself at this point is, how many more of these absolutely epic moves are you going to choose to miss? I mean, even Citigroup right here, you guys were up 500% on this one like last week. This thing is still ripping over here after being included in the watch list. So, for those of you guys that still need to hop in there, again, you can get your first month for literally $1 a day with this link I'm throwing in the live chat right now. Use code December. That'll get you the discount. You guys can join us in there. Congratulations and shout out to all of the people that joined us in there today. We're going to get you guys up to speed. And after what we are seeing today, guys, we are probably going to see a lot of really, really insane moves. If you guys thought the 35,000% plus trades in like 2.5, 3 months was absolutely nuts, I don't think you're ready for what's about to happen. But again, you have to know how to execute these moves on these moves if you want to have any chance at long-term success. Again, it's the simplest way to be operating in the market. I seriously don't know why everybody doesn't do this. When I explain this to people, they're like, it's that simple? I'm like, yeah. They're like, why are all the statistics out there that everybody fails? And I go, I don't know. They don't do this. So, guys, I will see you guys tomorrow at 10:30 a.m. on the stream. All of you guys in LTMP, obviously I'll be live at the normal time at 9:15 on the private stream. Friday we got public live day. I'll probably have some YouTube videos out for you guys, or one YouTube video out for you guys tomorrow and another one this weekend. But all right, guys. Really interesting day. Congratulations to everybody on all the gains. We're going to keep doing it. I'm going to keep handing out the best trades in the market to everybody and just doing what we do best. So, guys, I will see you guys later.